Hello, this is Charting Man Dan of TheChartGuys, where we teach the little guy and girl how to utilize charts to manage their own trades and investments. What do I mean by the little guy and girl? Well, we just had two directives signed halting the implementation of a rule that requires financial advisors to act in the best interests of their client. Let that sink in a little bit. The big wigs on Wall Street can play with your retirement and hard-earned money without your best interests at heart. We currently have hundreds of members taking charge of their financial future, and we would love for you to come check out a free week with no credit card required to see if our services would be beneficial on your path to financial independence as well. What we offer, we have a separate course of over 5 hours in length on when to enter and exit positions. And in terms of what we do daily, we have nightly videos, key levels updated each morning before the bell, 2.5 hours of live daily webcam coverage in the morning and in the afternoon, and over 7 hours of educational videos. All of these links can be found in the description of this video. Come check us out. Thanks for watching. Let's get on to the technical analysis. Hey everybody, checking in on the market rundown, SPY, IWM, and QQQ. I've already shared my opinion a couple times. I'll do it real quick on the FOMC tomorrow at 2 p.m. Eastern. And that is that I do believe a March rate hike is completely priced into this market. That is not going to be the driving factor unless we see no rate hike, in which case we'll get a bullish reaction to gold and the market. It's going to be the language going forward and what the market is going to interpret that language as in terms of how many more rate hikes are coming in 2017. That is going to be the driving force, so that is a bit up to interpretation. It's not a black and white answer, yes or no, in terms of rate hike, which is, again, pretty much a sure thing in terms of percentage expectations at this point. So the bulls bought the dip today on SPY. It was a very bearish start to the day, but not surprising that the bulls are defending this middle Bollinger Band, as that has what we have been seeing in 2017, the entire year so far. Big lower wicks back in July, 2 times big lower wicks off of this moving average support, which is currently 236.75. And pretty much the way we are set up right now heading into tomorrow, if we see a bearish reaction to the FOMC, we are going to set the tone on the daily time frame to shift from bullish to bearish, because then we will have our lower high and lower low breaking the bull trend. If it's a bull reaction to the FOMC, we're going to look to break 238.02, and then we're looking at the all-time high. So pretty much tomorrow is going to be the momentum and the driving force behind a move to the all-time high or a break of the uptrend on the daily time frame, which is going to lead to more prolonged consolidation on the weekly time frame. Speaking of weekly time frame, at this point, that consolidation is still very bullish, holding all exponential moving average supports very contained, no big red flags, no big volume spikes to the downside. So the bulls have nothing to worry about at this point, and the bulls really aren't worrying unless we lose exponential. The 8-period exponential support has held this entire bull move all of 2017, and it's been holding now pretty much since back in October, ever since the election results. So exponential support on the weekly time frame is what will dictate whether or not the bulls are still in control on this longer term time frame, and as of right now they still are. IWM, further weakness, and it ended up being a bear flag in the sense that we saw a weak bounce attempt. We rejected from the 50-day moving average, and then we dumped to lower lows. Now the bulls did buy that dump, and we've seen a couple long lower wicks down here, but the bulls must confirm this reversal candlestick. This is a bullish reversal hammer. We must confirm it with another green day tomorrow, and we now know this 50-day moving average resistance is going to be key to watch, as we have rejected from it on the last bounce attempt. 136.69 is that level. So personally, if I were going to be trading SPY and IWM, I would pretty much, if the SPY bulls are in control, I'm playing SPY bullish. And if the SPY bears start to take over, I'm going to hop in IWM bearish. And again, I've been pointing out how it has been more magnified to the downside. It is weaker than the S&P 500. So it's almost like a little bit of extra gains to the downside. When we see weakness in the S&P 500, it always translates, or I shouldn't say always, but at least in the past month, it has translated to more weakness in IWM. The weekly time frame is right here at the middle Bollinger Band, 134.29. Bulls need to hold that level going forward. If we were to close right here, right now, this would be a bullish doji trying to form a higher low compared to 133.12. If we lose that middle Bollinger Band, the higher low pattern on the weekly is at risk, so the bulls really want to hold that level, 134.29. QQQ on the daily time frame, bulls buying the dip. Again, 2 times, really 3 of the last 4 days, big time dip buying with big lower wicks. That tells me bulls are loading. Obviously, the reaction to the FOMC tomorrow is up in the air, but last time we saw big lower wicks with bulls loading in these markets, it was SPY back in January that led to a big time breakout and continuation. Though the middle Bollinger Band continues to ascend 130.44, as long as the bulls form a higher low compared to 130.14, they remain in control, higher lows and higher highs, and our new support is the low of today, 130.76. The weekly time frame slightly trending to the upside, inside candlestick last week. We did get a bull break of that inside candlestick just by a couple pennies, but the bulls clearly have momentum. And the same thing here with the exponential moving averages dictating the strength on the weekly time frame. We've held the 4-period exponential moving average in all of 2017. That's currently at 130.67, and we are still seeing the bulls in full control. So tomorrow is going to dictate where we're going to be looking for the next week or two at least. And again, clear levels of bull and bear action to be watching on the S&P 500, and be cautious of a knee-jerk reaction, which is when we see the price do one thing for the first 5-10 minutes on the reaction to the FOMC before completely turning around and going in the opposite direction. Utilize those shorter-term time frames, the 5-minute time frame, or if you want to zoom in and get some more details, the 2-minute time frame. So thanks for tuning in. We'll be live for the FOMC at 2 p.m. Eastern. Hope you have a great night. We'll see you soon.